Herkese merhaba. Piyasalara yine özel bir parantez açarak devam edelim. Cripstone stratejik makro kurucusu Mike Harris ile birlikteyiz. Hi Mike, thanks for joining our program.
Hi, thanks for having me, Berfu.
We are now roughly 4 months into the year, and of course, Iran war has changed the game for everybody. What stands out most to you? What has been the true economic cost of this Iran war for the global economy so far?
Well, obviously, from a global economy, it's just been associated with the supply risks to oil and what it means. I think usually people view things as one-off shocks, but pretty much we understand now that the mistake the U.S. has made is this is not going to be solved until Iran is happy with the outcome, because then we're always now, unlike before, going to have the capacity for people to fear what will happen with Hormuz. And with that new leverage, it really raises the risks, because in the past, when they hit Iran in the past, it was always one-off. It was a little more like a terror attack. And the markets could adjust quite quickly. Now, the markets have been fine right now, but I think there's just a lot of complacency that this isn't going to feed through, or that there is some solution on the horizon. It is really, really difficult to see a solution that will get us to the stage where Iran says, okay, we don't need to use this leverage in the future. So basically, and a sustained ceasefire isn't good enough because it doesn't get us to that level where people believe the ceasefire is ultimately sustainable. That sounds complicated, but basically every time Israel wanted to, and the US more recently, they were hitting Iran, and we have to remove that from the equation, because now Iran has a way to punch back that hurts. It might not directly hurt Israel at all, even if it does, but much more importantly, it hurts the global economy.
Yeah.
So we're in a situation where the outlook for the markets, I think, it's one where it's very, very easy to see this year being a horrific one by the time we get to the end of the year from a market perspective.
Yeah, because when you look at the Wall Street, they're making the pricing like there's no war. But oil prices are over $100, but all the investment banks, including IMF, they assume that oil prices will be around $80. So they see it temporary. But if oil remains around current levels, what kind of a bill do you think that could create, for example, for countries like Turkey in terms of inflation, growth, and current account? What do you say?
Well, it's negative on all fronts. But I think, thankfully, Turkey started this process with a very high real interest rate. And I was arguing we would get 600 basis points, 700 basis points of cuts this year as we move towards 25% inflation. That looked a little less strong when they raised the minimum wage 27%, because it became clear that there was a little less commitment in terms of future disinflation. Mm-hmm. But the fact is, Turkey's interest rates are not wrong. The market is not going after the currency, and outflows haven't happened because the view is the central bank has the wrong policy rate. In a lot of countries, when you have outflows like we've seen from Turkey, it's because the market is saying you're making a mistake. We're not getting paid enough to hold the lira. In this case, this was a risk appetite view that had nothing to do with the price of the lira and everything to do with the fear of being in a country in a time like this globally. I think that means that the impact is more one-off in terms of outflows. Turkish interest rates are absolutely not wrong. And, assuming we don't have to have a massive recovery, but if we're in a situation where it looks like definitively that the hostilities are not going to reassert themselves, and even if oil stayed at $95, $100, but it didn't look like there would be supply disruptions. It didn't look like from there would be a further spike at some stage in the future. I can see a scenario where Turkey is capable of cutting rates before the end of the year.
Oh, okay, I was just going to ask, is there room for interest rate cuts in Turkey at this stage? And is the current exchange rate policy in Turkey is sustainable? Because we know that this is also a discussion in Turkey. Do you see any dollarization risks? And how do foreign investors assess, for example, reserve adequacy and dollarization risk and overall currency stability?
Well, I think reserve adequacy is interesting, because in the past, whenever Turkey spent reserves, it was a sign of weakness. Now, what we've seen is this central bank has enough credibility that they've created in the past couple of years that when they spend reserves, the market believes that they're spending reserves for the right reason, not to defend something that is unsustainable. Now, I say that from an interest rate perspective. I think they're making a mistake from a currency perspective because think like when the IMF bails out a country, they give a big loan, but usually first they have to get things right. And what they should have done is allowed the currency to weaken some on the back of the shock, and then step in, spend reserves, hike the overnight rate, allow the overnight rate to rise like it did. And then show, if I'm right that the only reason money was leaving because it was going to leave anyway, almost irrespective of the rate, that was a good time to let some steam out of the currency. But this central bank, unfortunately, they're so married to the currency as being a driver of the disinflation program that every time we get a higher inflation read because of, as we will now, because of what's going on with oil prices, all that means is greater real currency appreciation. So it's sustainable from a shorter term perspective, but it's going to be painful from a longer term perspective. And every bit of real currency appreciation that Turkey is capable of achieving shorter term in the name of lower inflation, I think is structurally damaging. So I personally think that they missed an opportunity to let the currency go 5%, then to defend it. No one would have thought that, they were obviously so paranoid that there would be a spiral if they let the currency go a bit and there would be dollarization. So it shows the vulnerability of Turkey. And that vulnerability has almost nothing to do with the central bank and everything to do with the politics. Yeah. The reason we're constantly worried about dollarization and capital flight is not because of the central bank policy mix. It's not because of its inflation. It's because people know there is a political scenario in Turkey. We worry about Iran, but there's a political scenario in Turkey which can cause capital flight. And until it's clear that Turkey has found political equilibrium, we're always going to basically have to be excessively conservative as a central bank in dealing with the currency, and that's a liability for Turkey.
Yeah, as you say, it's a two-edged sword. If they let the currency go up, then it will create inflation in the end. So
no, I did not say that. I did not say that. If they let the currency go up, they're worried it will create dollarization. But the currency has nothing to do with inflation now. If it had anything to do with inflation, inflation would be much lower. Turkish prices are moving because of wages and because of domestic inflationary pressure. The currency is an artificial crutch, and that argument that the currency drives inflation is a lazy historical argument. And I think it's one where there's too much reliance on the currency and not enough on the fundamental underlying driver of inflation in Turkey, which in the past years has been wages. They learned that recently, but now it's going to get tougher. So I would stress that when the central bank says they're defending the currency because of inflation fear, that's wrong. They're defending the currency because of dollarization fear, and that dollarization is because of Turkish politics. It's not because of central bank policy or inflation.
But, as you also said, this was what we have seen in the past. If they let the currency up, it would create inflation because of the pass-through effects. But this is not the case now?
I'm saying because the pass-through effects from the currency strength would mean inflation would be nowhere near as high as it is right now. We've had huge currency strength in Turkey, huge. So it shows you there's been a disconnect. You look at prices in Turkey versus internationally, they're very high in dollar terms. And so my point being that the traditional connection between the currency and inflation is gone. It can come back again tremendously if there's a capital flight and dollarization. So my point that I'm making is the central bank's unwillingness to let the currency move at all on the back of the Iran crisis was largely due to fears of dollarization, not inflation. Now, they'll say it's because of inflation because that's politically more palatable, but the practical reality is the politics in Turkey create dollarization risk. This is a structural economic vulnerability that Turkey, we worry about Iran being attacked and Iran now attacking Hormuz. In Turkey, we worry what happens with the politics. And as long as you have a thought process like that, you have to think that dollarization is a risk. So I want to say this quite strongly. The politics are a much bigger driver of Turkey's lack of credibility than the central bank policy.
So what could policymakers have done differently under the current program, or what can still be done? What do you say? Because this is also a discussion in Turkey about the current program, economic program.
Yeah, so I say they should have let the currency go and then defend it. That would have taken a little pressure off. They didn't. They missed their chance.
They didn't.
Maybe next time they should do it, if there's another next time. But the other thing, now it's difficult, right? Wages, it's tough to bring down inflation just based upon wages. Confidence and conviction go in the future. If you take away the dollarization risk, if something positive happens politically that people realize, we don't have to worry about future protests in Turkey, which is basically what we're worried about, and a lack of political stability because there's no longer a democratic safety valve via the electorate. If something reverses on that front, it's going to anchor and make the disinflation and the growth, because Turkey needs to attract investment to help bring inflation down structurally at this stage. If it's all driven by wages and interest rates, inflation can fall, but it will be incredibly painful. And everyone understands that's really, really tough from a political perspective. So the disinflation outlook in Turkey is still there, but it's one that's going to become much, much more challenging politically unless we get a confidence boost that allows people to say, oh, capital is going to come into the country for real, not just to invest in short-term, highly liquid investments, but to actually for fixed capital investment. And then I think people could start to argue for a disinflationary momentum. Of course, if the oil price falls a lot, people will get a little more excited about disinflation, but we'll just be back where we started at the beginning of the year, which is fine. Interest rate cuts will happen. We'll get a little growth on that. So I'm not saying this is an unsustainable scenario, but the likelihood is we have to get used to higher inflation, because the future inflation targets are going to be incredibly difficult to meet unless there's very, very strong political will to, for want of a better word, shrink the economy.
And lastly and shortly, looking ahead to May, June, summer months and the rest of the year, how do you see the outlook for both Turkey and global markets?
Well, I think I think it's very challenging to get a full and final solution where Iran is happy with the outcome. Okay, they're not going to like the outcome, but they're happy enough to say we can settle for this. So I think we're going to be stuck in the situation where we continue to worry, and if we continue to worry, there's Turkish tourism, Turkish transit, from the Gulf, with the Gulf being a little less in play. In theory, Turkey should be benefiting from that, but it's negatively impacted by sort of regional guilt by association, which is unfortunate, but I think it's true. So I think tourism will have a tough year. So from a growth perspective, you have higher rates than you otherwise would have had. You have a little more, the cost pressure associated with oil, and you also probably have a weaker tourism season because this isn't finalized. And we have the continual fear of associated with Iran, which means a central bank has to keep rates higher than it otherwise would. Not raise them, but keep rates higher than it otherwise would. So, this is a somewhat recessionary is too strong a word, but growth will be negatively impacted. This is not going to be a great year, I think, for a lot of countries from a growth perspective and an employment perspective.
Mike Harris, thanks for joining our program.
Thanks for having me.